So if you have not already, I would strongly suggest looking at that final review document that I posted. There actually is 2 documents. There's one that lists all the things I want you to know or study, and then the other one is some practice questions. And then today we will go over several things that are on the final, including creating the financial statements. So I have a PowerPoint with a few of these things where, you know, I show an account and you tell me if it's temporary or permanent. And then also some journal entries that I want you to remember are on the PowerPoint. And then we will create those financial statements. So the first just says review. Can you see the slideshow? Yes, no, maybe. Hopefully you can see that slideshow. Yes, okay, I got it. I got a head nod. The first slide here then says your order of your financial statements. I believe this is a multiple choice question. Is first the income statement, then the statement of stockholders' equity, and then your balance sheet. After that, we learned the statement of cash flows, but I think on the multiple choice question, it just makes sure you understand the order of these first 3. And then knowing what is on each financial statement is really important for a majority of the test. So knowing that the revenue and expense accounts go on the income statement, and that creates what we call our net income or our net loss. Then you have that statement of stockholders' equity, which at the end of this PowerPoint, we're going to create all 3 of these financial statements. You would have just your 2 main equity accounts, common stock and retained earnings. And something I didn't list on the slide here is that dividends also shows up on that statement. And if you issued any additional common stock. And then the balance sheet is the last one. It should balance all of your remaining accounts that are assets, liabilities, and then the ending totals. Remember, all 3 of these statements are connected. So that's a quick rundown of the 3 financial statements that you need to know. The next slide says cash, and I would like you to tell me either on the chat if you think it is temporary or permanent, or with your sign. Checking every answers. Good. I see Matthews. Excellent. The correct answer is permanent. Ready for the next one? Remember cash, you don't, temporary and permanent accounts, they're saying, do you close them out, right? Only temporary accounts get closed out. We don't close out cash at the end of the month, quarter, or year. Ready for the next one? Unearned revenue. Let me minimize that a little bit. Unearned revenue. What do you think? I got a couple answers on our chat here. Unearned revenue. Also known as deferred revenue. This is a tricky one. I see several of you giving me the wrong answer. So we're going to talk about it. It is actually a liability. Does that help you? Liabilities are permanent. Remember, they say, here's what you owe. So unearned revenue, again, it's also known as deferred revenue. It says somebody gave me money and I didn't do the work yet. So I cannot call that a temporary account. I cannot close that out at the end of the month, quarter, or year, because it represents that I either need to give the customer or the client service, a product, or their money back, right? So it is definitely a permanent account. And this is on the, I know this is a test question on the final. Anybody want to tell me what financial statement this shows up on, this account, also known as deferred revenue?
The balance sheet.
Good, excellent. The balance sheet. It's a liability account. Yes, perfect. Good job. It's a liability, so it does show up on the balance sheet. Excellent. Next account, common stock, temporary or permanent? Your thoughts? Good job, Matthew. That is correct. It is permanent. We don't close it out. It's something, it's part of your equity. Excellent. Michael got it right too. Retained earnings is another account that I can't remember if it's on here or not. It might be, so I may have just told you the answer. That's another major equity account that does not get closed out, so it is permanent. All of your balance sheet accounts are permanent. Next question. Rent expense, temporary or permanent? Good. Three accounts. Good job, Matthew. The expense, remember the word I used, anybody, to help you decide which accounts are temporary? It's a color. Does that help? No, it doesn't help.
Is it red?
Yes. Oh, good job, Michael. Excellent. The red accounts, your revenues, except for that tricky deferred revenue. So Michael is right. Revenue is a temporary, expenses are temporaries, and the D stands for dividends. Okay. Next question. How about accounts payable? What do we think? Good. Good. Excellent. Moving on from that one because several of you got it. That is a permanent account. Good job. It's a liability. It shows up on the balance sheet. It says here's what we owe. Next, dividends. Temporary or permanent? Good. Good answers. Love it. That is a temporary account. Good job. I believe the next, we're going to move on to debits and credits, but I'm not sure. Nope, one more. Retained earnings. What do you think about that one? I already kind of mentioned it. Oh, you gave me your, I clicked it before you gave me your answer. Let's go back. Yes. Most of you are saying retained earnings is permanent. That is correct. Good job. Retained earnings and common stock are both permanent. They're the two main equity accounts. And then I think this is the last one of these, accounts payable or accounts receivable, sorry. Permanent or temporary? Good. Accounts receivable. What kind of account is it? Let's answer that too.
An asset.
Yes.
Good.
That's it.
I heard asset from two of you, and then Calvin also typed asset. That is correct. It is a permanent account. I believe on the final, you will have to know the definition of several accounts. The definition of accounts receivable is money owed to you from your customers or your clients. So I would either have the definitions handy to most of the accounts, or I would go ahead and write them out like before the test, the study. Min, did you have a question?
Yes. Is the note receivable is the asset?
Good. Notes receivable, yes, is an asset. It's just a long-term amount owed to you. Instead of it being owed over like 30 or 60 days, it is something that a client or a customer or somebody you have loaned out money to is paying you back over maybe multiple years, maybe 5 to 10 years. So the notes receivable is also an asset. It's just a long-term. This accounts receivable is a short-term asset.
I got it. Thank you.
Uh-huh. Good question. Okay, the next one, we're going to say, does cash increase or decrease with a debit or a credit? So if you have a separate piece of paper where you want to show, or type it in the chat. So cash increases with a I think most of you chose this. It looks like on the chat. Good. I got a debit answer too. Good. Remember that I'll say it later. I'll give you a chance to answer a few more of these. But cash is an asset, increases with a debit. On the final, you're gonna have to, it's gonna have two columns, and it's gonna say debit and credit. And so in the debit column for cash, you would put increase. You would put increase in the debit column, and in the credit column, you put decrease. Next question. Retained earnings. Does it increase with a debit or with a credit? Does it increase with a debit or a credit? seeing this as your answer for most of you. Credit came up on the slide there. Ready for the next one? Liabilities. Do they increase with debits or credits? Good. I'm seeing most of you saying this one, credit is the correct answer. Remember, assets on the left, if I had my whiteboard, well, I'll use it later. On the left, increase with debits, but liabilities on the right increase with credits. Next question, dividends. Let's see about this one, it might be tricky for some of you. Oh, this one did stump some of you. It actually increases with a debit. Remember that word? That's what I was going to say earlier, but I didn't want to give away all the answers. There's another word that I tried to use or memorize for some of you, that certain accounts, even though they're on the other side of the equation, are said to increase with a debit. And the word was dead. Remember that? Did anybody? I think somebody typed that on the chat. Yes, good job. So dividends increase with a debit. On the dead list, it really says debit expenses, assets, and dividends to increase them. But what is the funky thing? Why is this still follow our equation? All the assets increase with debits and they're on the left. And even though dividends and expenses are on the right, why is it okay for us to say that they increase with a debit? Do you know?
Because they decrease common or retained earnings.
That is correct. Gracie said, I don't know if you heard her, but it's because they decrease. We want to show things that decrease equity with a debit. And since they have actually a negative identity, expenses and dividends, when I say I'm increasing them, I'm doing two things. I'm increasing the expense and dividend account, but I'm decreasing equity. So you got to remember that on the test, that expenses and dividends always decrease equity. They are said to increase with a debit, but they are decreasing equity. Okay, a couple more. Oh, we just did this one. So I know you guys will hopefully, most of you get this one right. So expenses, do they increase with debit or credit? Good, good, good. They do. They increase with debits, that dead list, and it's because they also have a negative identity. Expenses increase with the debit. I think we have one more here. Let me see. Yeah, common stock increases with the debit or credit. Good. Good. Your chat and your signs look good. Increases with a credit. Oh, I lied. Maybe this is the final one. How about revenue? Increases with debits and credits. Good. A lot of you said that revenue increases with a credit. That is right. I'm going to go over that dead list again. I typed it on the chart, on the chat, but the dead list says that you will debit expenses, assets, and dividends to increase them. If an account is not on that dead list, such as revenue, there's no R in the word dead, they will increase with credits. So if it's on that list, it's said to have increased with the debit, but if it's not on the dead list, such as liabilities, common stock, retained earnings, revenue, those things increase with credits. Good job. Okay, last one. I keep on lying. This is the last one though, I promise. Assets increase with a good. I saw your signs. Excellent. Isn't it just like being in the classroom that I made you write these things? The correct answer here is debit. Good job. Okay, so you don't have to hold up any more signs. We're going to go over a few journal entries that you'll need to know. And these journal entries on the test, the way they will show up is as drop downs, something you're kind of familiar with on the homework. But it's going to say you purchased inventory on account January 14th for $90,000. So when you purchase inventory, let me double check here. Yeah, that is an asset account, right? Inventory. So that would be my debit. And since it says it's on account, it's going to be a credit to accounts payable. I'll let you either think about that or write it down. Questions on that first journal entry? Nothing? Okay. On the 17th, there are actually 2 journal entries. You're going to debit accounts receivable and credit revenue. So that says I made a sale. Remember up here, there are trigger words. The sales word tells me I need to record revenue for $120,000. It was also on account, but this time I have to debit accounts receivable because I should be receiving payment from my client. And then on the 17th, there is a second journal entry that will be for a smaller amount. This one should reflect the cost of your inventory. And so it will say, I debit cost of goods sold and I credit inventory to get that off my shelf. Do you remember, 2 questions on this, what kind of account cost of goods sold is?
Expense account.
I think I heard somebody say it. I'm going to repeat it. Good. Expense. Cost is a synonym for expense, and you will have to know that on the final, that the definition of the word expense has cost as part of the crux of the definition. It's a cost of providing your goods or services. So you're going to debit an expense account called cost of goods sold when you sell the inventory. And then the second question in relationship to this slide, do you remember how to calculate gross profit according to these 2 transaction or 2 journal entries on the 17th?
Don't you subtract your revenue from the cost of goods sold?
Good. You compare that revenue and the cost of goods sold. So in this example, your gross margin, I'm going to write it on the chat here, your gross margin is going to equal $30,000. You will have to do inventory calculations. So you might want to refresh yourself on FIFO, LIFO, and weighted average. That was in chapter 6. But this is the first part of chapter 6. It was learning those journal entries for inventory. Okay. Questions on this slide? All right. Adjusting entries. There are 5 adjusting entries you have to do. So the next, this slide and the next one will include all the adjusting entries you have to do. I did not put the amounts on here. I just put the accounts that you will have to record. And again, these are also drop downs. So if you're unfamiliar with how to calculate the amounts, you need to go back to chapter 3 and work on how I would calculate the supplies adjustment amount. So when I use up supplies, what do I debit? Any guesses?
Supplies expense.
Good, excellent. Supplies expense. A lot of your adjusting entries, and that's why I put these first 3 on this same slide together. A lot of your adjusting entries are going to debit an expense account. So when I use the supplies, I will debit supplies expense to show the used amount, but I have to take away from the actual asset, so I'm crediting supplies. The next journal entry, when I use up prepaid insurance, looks very, very, very similar. I'm going to move this out of the way here a little bit. Yeah. I will debit the insurance expense and I would credit prepaid insurance, but that will have to be for the amount that you actually used. Don't record that as the amount you initially purchased. That has to be for the part that got used up. So if I bought a whole year's worth of insurance, let's say on November 1st, I would only record 2 months on the adjustment as being used. And then the last adjusting entry on this slide is the calculation of interest on a loan that you have taken out. it will, again, another adjusting entry that debits an expense account. It would debit interest expense and credit interest payable. And I don't have it on the slide, but you will have to know how to calculate that. Remember, it was the loan value principal times the interest rate, and then prorated for the number of months that have actually passed. So divide by 12 and multiply by the number of months that have passed. Questions on any of those adjusting entries? Okay, so the other adjusting entries are these first two, the utilities accrued. Let's take a random guess. What kind of account do we want to debit? Any guess what you want to debit here?
Utilities expense.
Good job. Excellent. Utilities expense. So utilities expense reflects the amount that you've used, and the accrued part just tells you that you haven't paid it yet. So good job. Same, these are gonna look very similar overall. Adjusting entries reflect that time has passed and something has been used up. The depreciation entry is gonna debit an expense account, depreciation expense, and then it's gonna credit accumulated depreciation, which, do you remember what kind of account that is? I'm not sure if it's on the chat or not.
Contra asset.
Good, it's a contra asset, very good, excellent. So what's happening here is I'm decreasing equity. All of my expense accounts decrease equity, and the accumulated depreciation is decreasing assets. Good job. And then the last one I put on this slide, because I know it's a multiple choice question, is reflecting what you would record when you provide services on account. It's not an adjusting entry, but it is one you'll need to know for a multiple choice question. So you would debit the accounts receivable. Remember, the word providing services tells me I need to record service revenue. I did work. And then the accounts receivable says I haven't been paid yet. Okay, two major accounting principles that we've discussed and will be on the final as multiple choice questions are the revenue recognition principle. It says you record revenue when it's earned. So only when we do work do we record the revenue, right, on the revenue recognition. The matching principle says that expenses and revenues have a relationship. Remember, I would do this sometimes. And they need to be recorded in the same time frame. So if I had, here's a good example, insurance, and I remember we said on the adjusting entries, if I paid for a whole year, I would only record the amount that I've used in the current year to generate revenue. Or supplies, I would only record the used amount of supplies that I had to use up to generate that revenue. So these are easy, I think, multiple choice questions if you will make sure you're familiar with the definition of those principles. Any questions on those two? Okay. Then closing entries, this is the last slide. You will have to do these as drop downs. Remember, I highlighted these in red because these are the three types of accounts that you close. You close revenues, expenses, and dividends. And you do the opposite of their normal. So just how we went through that list earlier, and we said the dead list, that tells me that I'm going to debit expenses, assets, and dividends to increase. That's also telling me they're normal. So dividends normally have a debit balance, but when I close them, I will credit them. And then the expenses normally have debit balances. So when I close them, I will credit them and debit into retained earnings. And revenue normally has a credit balance. So to close it, I would debit it and credit retained earnings. Questions on those?
I have a question that on the revenue, how about the sale discount? Do we need to debit it or credit it?
If you were closing, if there were a problem, I know on the final, when I make you do the closing entries, you don't have sales discount, sales return, or sales allowances, but those normally have debit balances. So I would credit those accounts, Min, to close them. They are like expenses, okay? They offset the revenue, they decrease the total revenue, but on the closing question for the exam, it won't have those as part of the problem.
Okay.
Any other questions on the closing entries? Nope. Okay, last thing then for this review is going to be for us to create the financial statements. So I'm going to share my screen with you again for you to see the problem. So remember, the first financial statement that we create is the income statement. And the way this will show up on the exam, good for you for coming to the review. I believe I have it set as where you can insert a Word document or an Excel document. So if you already kind of have yourself a template set up, you know, it would make it faster and easier to get these financial statements into the exam, if that makes sense. So your first account you want to list, I'm going to highlight them as I write them down, is service revenue. And it says that it is $100,000. I'm going to abbreviate 100,800. And you're going to write down cost of goods sold because it's a major expense. Now, I'm not picky on the format, but I'm just highlighting these because remember, when we use an account, we don't use it again. It's going to go down right below the revenue amount. And then I'm going to list any other expenses. You could put gross margin on there if you wanted to, but you don't have to. So the other two expenses I see on this problem are the delivery expense and the salaries expense. Deliveries expense looks like it's 3,500. Oh, I hope that you guys are ready to do your good math skills because I think I kind of remember what the answer should be, but if you take 100,800 and you subtract off 78,300, 22,500 minus 3,500 would be at 19,000 minus 10. What do you think? Anybody agree with that math? 9,000? Okay, good. I got a second. Financial statement is called your statement of stockholders' equity. What should be on that statement?
Common stock and retained earnings.
Excellent. Common stock and retained earnings. So really, it has a beginning, middle, and an end. So I'm going to, this one in red, I'm going to abbreviate common stock, and it will have a beginning balance. And that is given in the problem down here in the paragraph. It's the exact same format on the exam, just different numbers. So you should be well prepared for this part. So I'm just going to take the beginning balance of common stock. I'm going to add the additional issued that it says here of 5,000. So we have this 40 and we have this 5. I'm going to add those together, and that's all that happens to my common stock account. So it could have, you could have the balance down here because nothing, the dividends and the net income are not going to affect the common stock. So the balance of your common stock is now 45,000. The other account we said was retained earnings. I'm going to put it over here. Retained earnings has a beginning balance, it says, of 21 right here in the problem. And then I am going to leave this spot blank right here. Not going to put anything in there. The issuing common stock does not affect retained earnings. Why do I have this purple marker? Any ideas? Where's that box come from? Where does that amount come from?
Income statement.
Very good. That is correct. The income statement. So we said it was 9,000 net income on that first statement. I already wiped my board off, but I used the purple marker, remember? And it was 9,000. And then it says one more thing in the problem, that you have a $7,500 dividend down there. So we're going to subtract that 7,500. So what does that look like? 22.5, I believe, for that one.
Yes.
Okay, great. Thank you. Okay, so we're done with the second financial statement. The last one is your balance sheet, and you should just be writing down any accounts that are remaining and putting them in the right area. So I'm going to type that one actually on the Word document. So it's going to have assets first on here. We're going to list assets. And it's going to be all of these that I haven't used yet, just cash and equipment. Now, typically we write things in order of liquidity, but I am not picky on this format. So I'm done with those two. I didn't really mean to cut them and paste them down there, but that's okay. We can do it that way. The buildings and the supplies also are assets. So we will cut them and paste them down there too. The main one that some of you are, well, I shouldn't say the main one, but one of the accounts that will confuse some of you is the accumulated depreciation. When I put that down here, it actually typically goes right below either the building or the equipment, but because it's the contra asset, decreasing the overall value of that account. But the important thing is to remember that's a negative account. So I have all of the assets listed right now. So if I want to total these up, total up my assets, we're going to have to use calculator real quick. Somebody probably already has that math in their head, maybe. 16,000 plus 29,500 plus 42,000 plus 1,500 minus 8,000. Okay, so it looks like the total assets, 81,000. Where did I get it down here? Questions on that? I was going to bold that last one. Okay, so when you total up your assets, it's kind of like a little checkpoint for yourself. All of the other accounts need to equal the liabilities. Remember, all the assets need to equal the liabilities and the equity. Typically, I kind of have bad formatting going on right here, but you would start a second column, like over here to the right in this section, but I'm just going to do it below unless I can't seem to get that. Oh, the accumulated depreciation is following my return button. Let me try just jumping down here. Okay, so liabilities are anything that says payables, right? So we still have the accounts payable and we have the salaries payable. And remember that deferred revenue is also a liability. So once we add up these liabilities, this is why I liked using my whiteboard instead of this Word document. It's not cooperating. I need this one. Now you can see I've used all my accounts, right? Because remember I highlighted the yellow ones when we used them. So I actually used this one. It just didn't delete off of there. Cancel that. My total liabilities look like they're 13,500. I did good math, yes. And then my equity section, remember from the whiteboard, I still have it over here. I didn't lose it. Remember the two accounts that we were looking at were common stock and retained earnings. So my common stock account, it was equal to $45,000. And then the retained earnings, it was equal on my whiteboard to 22,500. I really hope this balances. I didn't do this math before I got on here. So the total liabilities plus equity would be, if I add up the 13,500, the 45,000, and the 22,000, hopefully it will be $81,000. Oh, you got too many. Yes, it did balance. So what I did there at the end, when I added up the total equity with the liabilities, was just that 13,000 plus the 45,000 and the 22,000. Any questions?
When we
Yeah,
get our
I had a question.
Yes.
How did we get the 22,500 for the retained earnings?
That was the, let me see if you can see this on the tiny little. Can you see the whiteboard, Susan? No.
Mhm.
It was the beginning retained earnings. I didn't highlight them on the
Okay.
Word document of 21,000. Plus I added
Mhm.
the 9,000 net income. And remember
Okay.
that 9,000 net income was our revenue minus our expenses.
Okay.
So we were at 21,000 plus 9,000, which is 30,000, minus this dividend. So
Mhm.
when I take 30,000 minus 7,500, that is how we came up with that 22,500. Good question.
All right. Sounds good.
Anything else? I would do that because the stuff I went over today is important for the final, but there are other things also on there. This would get you through a majority of it, but there's several things that I didn't cover today that are on the final. Mainly definitional things and reviewing for some of you, like those inventory systems and depreciation. You have to remember how to do straight line depreciation and activity-based depreciation. And then you have one question on a bank reconciliation, how to reconcile a bank rec. So, any other questions? You ready to get off
Yeah.
here?
I think I missed this at the beginning of the call, but what is the story with all these assignments due on Sunday?
We did talk about that. Those interactive presentations are optional, Matthew. They're just
Okay.
kind of a additional learning resource tool to help you hear somebody talking about, because it's made by the textbook and it's kind of a
Oh, okay.
presentation.
So
With,
it's not required or anything?
no, it is not.
Gotcha.
Yeah, good question.
Do you know exactly how many multiple choice question on the test?
There are 50 multiple choice questions, and I believe they are each worth 2 points. It might be a little less than that. But then there's 8 things that are what I call open-ended. So like those matching for the debit and credit, the temporary and permanent, you have to know what things are operating, investing, and financing. You have to do those journal entries for closing, adjusting, inventory, and creating the financial statements. And then I think there's a little section on the cash flow for just the operating. So you don't have to do the whole cash flow statement, just that operating section.
Okay.
Well, if you get to study and you have a question, email me, okay?
Do you know
All
how
right.
long we'll
Sounds
have
good.
to do the final?
You are allowed 2 hours.
2 hours, okay.
Yes. And it doesn't have to be proctored or anything. And I would have my book and notes there with me. So.
Okay.
Okay.
Thank you.
Welcome. Good to see you guys.
All right.
Hopefully I'll see you on campus next semester.
Yeah, for
All
sure.
right. Bye.